Hello and welcome to the lecture for part 1 of chapter 4. In this chapter, we're going to talk about businesses that are a little bit more complicated than the service businesses that we've been talking about up until now. And by complicated, I don't mean running the business, I mean the accounting aspect of it. When we deal with merchandising businesses, these are companies that buy and sell inventory. So we have a couple of new things to take into account there, and I'll get into that a little bit later. So in this section, I'm going to talk about how we record and report transactions dealing with inventory, both buying inventory and selling inventory. I'll talk about how we deal with purchase returns and allowances. That's what happens if some of the inventory that we receive isn't what we ordered or is damaged. I'll talk about cash discounts, which are very common as a way to get people to pay their bill on time. And if we have time, I think we'll have time, I'll talk about transportation cost. In the next lecture, in part 2, I'll talk about inventory shrinkage, which is what happens when inventory goes missing. I'll talk about gains and losses on selling assets, and I'll talk about net sales. So first of all, some definitions. So a merchandising business compared to a service business is a business that buys inventory from suppliers. So those are the goods they're going to sell. And they sell those goods to customers, either retail customers like end users or wholesalers that are going to in turn sell it on at a higher price to earn a gross profit. That's the objective. So gross profit is the difference between what we sell a product to a customer for and what the cost to us is. So some examples of merchandisers would be Costco. They buy and sell things, of course, Walmart, and then our university bookstore is another one. So I'm going to go ahead and use an example as we're talking here. Let's pretend that we open up a pirate used bookstore, that we want to compete with the university bookstore. We think they're charging too much, so we find an empty classroom and we tell all the students, we'll buy books from you and we'll resell them to other students much more cheaply than the bookstore does. So we'll use that as the example of our merchandising business as we talk through things. So first I want to show you an example of a more substantial company. So this is AutoNation. They buy and sell used cars and I guess new cars as well. And you can see here they record their revenue in a bunch of different product categories. So they sell new cars to customers, used cars, they do parts and service, they do financing and insurance, and then they have an other category. And for every category of revenue, they also recognize cost of sales because each one of those things they sell to a customer has a cost associated with it. They don't have any inventory that's free. So we record the cost of the sale in the same period in which we sell the product. And the difference between the two is our gross profit, or what's left over after we record the sale, after we deduct the cost from the selling price. So that's a really important number for a merchandising business. It's important both in dollar terms. It's also important as a percentage of sales because it tells us what percentage of our sales price is being retained within the business to help us cover overhead like advertising and rent and insurance and things like that, and provide for a profit. So we want to really track closely what that percentage is and if the percentage is increasing or if it's decreasing. Okay, there's two different ways that companies record how inventory moves through the business. There's a simple way that is not very good and a better way that most companies use. But you may see both, so I want to explain both to you. So in periodic inventory, we're not going to keep track of cost as things leave our store. So if we have that pirate bookstore, students are going to come in, they're going to buy a Psych 100 book, an Econ 201 book, an Accounting 201 book, and they're going to give us money and they're going to walk out with the books, and we're not going to record cost or anything. At the end of the month, we're going to count all of our inventory and value it, and then we'll use this formula here to figure out how much the cost of what left our business was. So I take beginning inventory plus all of my purchases, just in dollar terms. That tells me how much product I had that was available to be sold. Then I count what is left at the end of the month and subtract that. That tells me the cost of what must have left my store during the month. So the advantage of this method is it doesn't require a computer system. It's simple, easy to do. The disadvantages are multiple. So one disadvantage is I don't know how I'm doing until I get to the end of the month and count my inventory. So I'm flying blind until I count the inventory and find out if I have gross profit or not, basically. The other disadvantage is if I come to the end of the month and the result is, say, a little worse than what I expected, I don't know what it was for any particular sale. So I can't say, oh, my problem is that my Psych 100 books are underpriced or whatever the case is. So it aggregates everything and I can't look at anything individually. And then the last disadvantage is books could have been stolen and I wouldn't know that because I'm only counting what's left and I'm not keeping track of what was sold. So those are the big disadvantages. This is how companies used to do things back before computer systems were more affordable. When I first started doing accounting, this is exactly how the company I worked for did it. I used to count the inventory at the end of every month. So the way most companies do it now, because software has come down in price, is perpetual inventory. So perpetual inventory means we're going to have records for every single item that we sell. So let's pretend we have a binder on the shelf that's our inventory, and each page in the binder is a different type of textbook in our used bookstore. So if I buy a bunch of books, I take that down and I record which books I bought and how many. When I sell books, I take that binder down and I record which ones just left. So I'm keeping a running total of what I should have on the shelf. The benefits to that are that I know what my costs are on every sale. So if my cost of goods sold is too high, gross profit's too low, I can trace that to a particular sale and solve a pricing problem or whatever the case is. I know what I have on hand. So if somebody calls and says, hey, do you have an Econ 201 book on hand? I can look it up in my system and say, yeah, I have 8 or whatever. And then by having that expected inventory, I can do counts from time to time. I can do spot checks and I can see if maybe books are being stolen and I need to increase my security. If I should have 8 on the shelf and I count and there's only 5, that must mean either somebody made a mistake or 3 books have been stolen. So those are the advantages, and I can stop at any point during the month and determine how I'm doing. I don't have to wait for the end of the month to come to see what the results are. The main disadvantage is that there's some additional training required of employees, and there's some software, and if you have scanners, maybe some hardware included in that. So those are the disadvantages, but the advantages far outweigh the disadvantages. So when we acquire inventory, it's just like the purchase of any other asset. So this is a new category we have called inventory, a new asset. So when we buy inventory, that's going to include all the costs to get it to us. Inventory is going to go up, accounts payable goes up. When I pay the liability, cash goes down, accounts payable goes down. We now have inventory on the shelf. We don't owe our supplier any money. This next transaction, when we sell product, this is really key. So put an asterisk by this in your notes or arrows pointing to it. When we sell the inventory, we're going to record 2 transactions. The first transaction is the sales part of the transaction. So we're going to record that we earned revenue, okay, because we provided product to customer, just like providing services to customers. That's when we record the revenue. So retained earnings goes up when we record revenue, and accounts receivable goes up because the customer is going to pay us later. So either cash or accounts receivable will go up and retained earnings will go up when we recognize a sale. The second part of the transaction is recognizing the cost of that sale. And I realize now that I have a mistake on this slide. I apologize. So when I recognize the cost of the sale, I'm going to reduce my inventory by the cost of the inventory, not what I charge the customer, but what it costs me to get it on my shelf. So I reduce the inventory because I now have less inventory, and I reduce retained earnings. So there should be brackets around the 4,000 for the expense under retained earnings. So in this case, I have a gross profit of $4,000 on the sale. Sale price minus cost. Now, sometimes we'll receive inventory and it's either damaged or it's the incorrect item, and we'll call the supplier and say, okay, this is a problem. Maybe we buy a bunch of Econ 201 books from PLU and they arrive and they're all damaged or they got rained on or something like that. So we can do one of two things. We can either return the items to the supplier, or we can get a price reduction on them because they're not as good as they should be. In both cases, we're going to reduce our inventory and reduce our accounts payable. Okay. So here we buy $10,000 worth of product. We owe the supplier $10,000. Next line, we see $800 of it is damaged. We return it. So we reduce our inventory by $800 because we took taken inventory off the shelf and sent it back. And we owe less money to the supplier. When we pay it, cash goes down by $9,200. Accounts payable goes down by $9,200. The other thing I want to talk about are cash discounts. So cash discounts are incentives we offer customers to, or suppliers will offer their customers to pay more promptly. The way they're written is 2/10, net 30 is the most common one. The way that should be read is 2% if you pay within 10 days, otherwise pay the net amount in 30 days. We could have terms that are 1/15 net 30 or 2/20 net 60, 1/15 net 45. The terms could be any range there, but that's how they're expressed. And again, it's to get people to pay early. That discount is going to reduce the cost of our inventory and reduce what we owe the supplier. So one way to look at this that's important is if you don't take that discount, in effect, you're foregoing 2% for the ability to use the money for an extra 20 days between the 10-day mark and the 30-day mark. That equates to a 36% annual rate of interest. So if you can borrow money at less than 36%, you're better off borrowing the money and taking this cash discount. You'll come out money ahead. A lot of businesses don't take the cash discounts just simply because of lack of organization. Getting bills processed and in the system and paid quickly enough. So that's a kind of low-hanging fruit to help a company's profitability is to start taking that cash discount. So the way that's going to look is I buy inventory, $10,000, I owe $10,000 payable. I see that the terms are 2/10 net 30, so I reduce the cost of my inventory by $200, reduce what I owe the supplier by $200, and then I pay that within 10 days. Now, one thing that's important to note, and this will help you with your homework, is if I return part of the product, say as example in this situation that I return $1,000 worth of the product, I would take $10,000 minus $1,000, and the discount, the 2%, would apply to the net purchase of $9,000. So the discount would be a little bit less. The last thing I want to talk about are transportation costs. So products are sold under either one of two terms, either FOB shipping point or FOB destination. In FOB shipping point, the ownership of the goods transfers to the buyer at the seller's loading dock. So if we bought a bunch of Econ 201 books from PLU and it was FOB shipping point with the terms, those become our products the minute that they cross the loading dock and get put into a truck. The cost of getting it to me, to the buyer, is the buyer's responsibility because it stops being the seller's goods the minute it gets put into a truck. If that truck crashes on I-5 and the books burn up, that's the buyer's problem, not the seller's problem. Okay, so the buyer is going to have freight costs to add to the cost of their inventory. Mentioned inventory is valued at what it costs me to have it on my shelf. So in this case, that includes freight. If the terms are FOB destination, that means that the ownership of the goods is going to transfer at the buyer's doorstep or the buyer's loading dock. So in that case, the seller pays the freight. They have a delivery expense that they recognize as part of their overhead, and the buyer doesn't pay any freight. In that case, if the truck crashed on the freeway and the books burned up, it would be the seller's problem, not the buyer's problem to resolve that. So hopefully that makes sense. So at this point, you have enough information to be able to do your first homework assignment for Chapter 4. As always, if you have any questions, please send me an email, and I look forward to talking to you in Part 2 of this chapter. Thank you.